What is up, guys? Anthony Esposito with eXp Realty, your local real estate expert right here in Cleveland, Ohio. And today I just wanted to go over some of the ways you could stay in a home while building a new one, because as you see right here, sales of a newly built home, they're outpacing the sale of existing homes. So the new home sales are increasing almost 9% year over year. That was dated back in November, while the existing homes increased 6.1% year over year. There's so much pent up demand. People are tired of not having homes. And quite honestly, brand new homes, all the builders, they are giving away money and incentives like hand over fist. So I'm gonna take you through the different ways that you can end up building a home without selling your current one. So ultimately, you're not moving two different times. So first and foremost, let's start with bridge loans. What are they? How do they work? Okay, right here, a bridge loan may let you buy a new house before selling your old one. Bridge loans can have high interest rates, require 20% equity, and work best in fast-moving markets. Now, the bridge loan, it makes it possible to finance a new home before selling your current home. And bridge loans may give you an edge in a tight market, but they come with their own risks and restrictions. So as you see right here, at a glance, you can typically borrow for a maximum of 80% of your combined value of your current home and new home. 6 to 12 month terms, that's plenty of time to build a house. That's typically right around where it's at from the time you sit down with them to the time that you are moved in. High interest rates and fees compared to conventional loans. Of course, building homes, construction loans, these types of loans are always higher interest rates than your standard loan, but not by a lot. And best in areas where homes sell quickly. This is all about timing. You don't have to have a bridge loan just because your area doesn't sell quickly. You gotta time the market properly. Depending on when you end up building is going to determine when your house is gonna go on market to list it and get it sold and tie everything together so you're moving one time. So what exactly is a bridge loan? It states right here, a bridge loan can give you the cash for a down payment on your next home before selling your current one. Without a bridge loan, you may be forced to make a contingent offer that depends on selling your home before closing. The bridge loan can buy you additional time to sell your home if you find one you'd like to make an offer on first. And it can help you compete in a hot market in which sellers may be unlikely to accept contingent offers. So that's based for existing homes. With these bridge loans, as far as a construction loan goes, they will take the bridge loan, and as it stated up above, the 20% with equity, all that fun stuff. They use the equity that you have in the house. They don't hold your current mortgage against you, is what it is, and they base it off of the value of your home. So it's almost like collateral a little bit, but it is a great way to get it around. So bridge loans are generally used one of two ways: to pay off your current mortgage and make a down payment on your new house, or simply make a down payment on the new house. Both scenarios assume your old house sells, allowing you to pay off the bridge loan plus interest fairly quickly. If it doesn't sell before the loan comes due, you may owe the full amount of the bridge loan on top of your new mortgage payment. This could lead to financial stress or even default, which it can, but this is worst case scenario type stuff. There's tons of pros to it. There's always something like a worst case scenario. Bridge loans usually must be paid off within 6 months to 1 year. Qualification requirements can vary by lender, but you'll maximize your chances by approval by having a credit score of 700 or higher, debt to income ratio below 50%. You can typically borrow up to 80% of the value of both properties combined. So a couple pros that are on there: you can make an offer on the house without a sale contingency, but this is for new builds. So you could use this for a new build to not let your mortgage work against you, is how this ends up working. Now, there may be high interest rates. Again, it happens. All construction loans are gonna be higher, as I said. You may have to pay for an appraisal on your current home, which those aren't crazy. in amounts, but that is a possibility because they have to find out what is the appraised value. And when it says right here, you may own 2 houses with 2 mortgages for a bit, that's just assuming that your house doesn't sell in the time that you close on your brand new construction house. Now, if you time it up right, you have your agent help you out and time it up right. I just kind of did this with a client recently. We have it set in place where there's a contingency in place, basically asking that, the seller is closing on their house around this time frame to either have an extended close or possibility of rent back, extra possession, a little flexibility from the buyers, and you can end up getting it. No problem. A lot of people understand, especially with the low inventory that's out there. You are limited to a loan-to-value ratio of 80% on both properties. May not be enough. Again, this is all stuff that you got to check with a lender for. I am not a lender. I just want you to get a, good overall knowledge towards the ways that you could end up building without selling your home first and foremost. That's just some examples that they're going over, and then they're talking about where you can find a bridge loan lender. They're out there. A lot of the lenders for the builders, they will look at the bridge loan itself as a possibility because they also understand too, they don't want you to move multiple times throughout this process. Now, as we look at construction loans, this is one of the most common that we see out there when it comes to building a brand new home, and basically pays for the home building or renovation and are paid in full or converted to permanent mortgages when the work is completed. Now, what does that mean exactly? We're gonna get into that. So what is the construction loan? Covers the cost of building or rehabilitating a house. The lender disperses the money in installments as the work advances. Once the building is complete, home construction loans are either converted to a permanent mortgage or paid in full. During the construction phase, the borrower pays only interest on the loan. So when you're building a house, the builder's gonna come to you and say, hey, we need to withdraw $20,000. You sign a paper with the lender that you have. The lender then releases $20,000 for that phase of stuff. Now you're gonna pay an additional interest just on that $20,000. So the next phase comes along and they say, hey, we need $100,000. You sign it. Now you're paying interest on $120,000. So it keeps accumulating and adding up, and you're gonna end up having that throughout the construction loan until you're officially closed, which then the lender will turn it into the main mortgage. And it says right here, when's it used? It's used to finance a custom home, house designed and built to your specifications, or to pay for a major renovation. So your chain builders, they're gonna be a little bit different with a lot of their construction loans of how they do stuff. But it could be very similar as well. They may use a construction loan. It really depends on the builder itself. But the majority of custom home builders, if they don't have like a bridge loan option for you, it's going to be your traditional construction loan. Now, it does say you do not need to buy a construction loan to buy a production home in a new development. With production home, the builder or developer finances the construction, which is very typical. You choose from a set of numbered or offered house plans features, and when the construction is finished, purchase the house from the builder with cash or a traditional mortgage. That is the common way, but I can't speak for every builder that's out there, but that is the normal that you end up seeing out with these construction loans and how they end up building it. So the different loan types right here, construction to permanent loan. This is the most common, especially when you're building a custom home. Construction to permanent loan converts to a permanent mortgage when building is complete, also known as single or one-time closing construction loan. It's a convenient option because you apply and pay closing costs only once. Interest rate is locked in at closing. Lenders may also offer float down option, which would let you get a lower rate at closing if mortgage rates improved during construction. So look into the float down option, obviously, since mortgage rates are, around the high 6s, because again, depending on the builder, it could be 12 months by the time you actually close on your house. So 12 months is a long time. There may be lower interest rates for the mortgage. Now there's also construction-only loans. This is a 2-close construction loan, so you're gonna close twice. This one is used, but not too often. The construction-only loan must be paid off when the building is complete. The loan requires the borrower to qualify, get pre-approved, and go through closing twice, once for the construction loan and once for the permanent mortgage. Construction-only loans offer more flexibility because you can compare lenders to find the best deal on a construction loan and a mortgage separately. The downside, you pay for 2 closings, as I said. And construction projects are complex, and they really are each unique. So when you are shopping for these, as they're even saying here, you do got to find the pros and cons. One of the nice things, and I talked about it in my previous video, is there is a means to kind of use a third-party outside mortgage lender to get a rate on a construction loan and use it against the builders with their financing company to still get the incentives. And then, of course, there's renovation loans if you want to look into that aspect, if you're just looking to renovate your home. Now, this one, not used very often, owner-builder loan. That's someone who plans to build their own home and act as the general contractor. Far and few that happens, but if that is you, there is that style out there. So, what does the construction loan cover? Land, plans, permits, fees, labor, materials, contingency reserves. Covers all that stuff. How does it work for loans to build a house? Disbursement of construction loan happens in phases. Instead of transferring a lump sum, lender pays the builder in installments called draws. Each draw coincides with an important phase of the project, such as pouring foundation, framing, finish work. And then an inspection may be required before each draw is released to the builder, and the amount of the payment is based on the work completed as noted in the inspection report. So again, you're making these draws every single time. Every single time your interest is going up and you're paying more and more and more as you get closer to it. Again, you know how you get them? You literally just gotta meet the minimum requirements, just like any other loan that is out there, mortgage loan that is out there. Now, I do want to point out that most lenders will require a credit score of at least 680, a down payment of at least 20% for new construction. So just keep that in mind. Not all builders are like that. Some builders are a little bit less. Some builders, you know, they only need a couple $1,000 down payment to get stuff rolling and get the ball rolling. Every builder is different and unique in their own way, so it just really depends on which one you're going for. And then it's just, again, typical stuff. You know, when you are under, like it's going to underwriting, when you do have a deal in place, do not make the large purchases, even on a construction loan. Always, always, always double check with the lender on your purchases. Another way to do it is looking into your HELOC and going into, which if you don't know, is your home equity line of credit. So there is a way to use it, as we see here. Acting as a second mortgage, a HELOC allows the borrower allows you to borrow against the equity in your home in the form of a revolving credit line similar to a credit card. With many HELOCs, you can borrow as much as you need when you need it, as long as it's within the draw period, the time frame you're allowed to borrow the funds. And if you're financing new construction with HELOC, you'll leverage your current home's equity as collateral. You can also use the funds you need, often through a card or check the lender provides you. As building project progresses, a solid benefit if you run into unexpected cost. So that is how you do a HELOC to build a brand new home, depending on the equity. But again, with the price of new homes, you're gonna need a lot of equity. So this one isn't used as often as a bridge loan or your traditional construction loan that is going on. Now, I do want to point out, to qualify, you'll often need at least 15% equity in your home, and you may only be able to borrow 80 to 90% of your equity. So it's tricky to do this one. It's not used very often. And then just a little bit of comparison between the construction loan and the HELOC for you. Yes, HELOCs are easier and quicker to obtain. They are. It can take 2 to 6 weeks to obtain a HELOC, while you often wait 30 to 60 days for a construction loan. At the end of the day, building a house is going to take time. The longer it takes, the better, in my opinion. I got 15 years construction experience. You want it to take a little bit to build a house. You don't want to slam that thing up and be done in 3 months. So even if you got to wait 30 to 60 days for the construction loan, don't sweat it. And then this is just showing you a couple different differences between the HELOC construction loan, like the funding, that's your home equity. Project milestones for the construction loan. Interest rates, lower initially, may increase later. Construction loans are fixed for the duration unless you get that flow to where they can give you a lesser interest rate when it goes to close. Qualifications, you need equity in your home. This one is just, you gotta have the plans and timelines in place, and the builders do all that stuff for you. Flexibility, you borrow as needed. And then with the construction loan, it's gonna be whatever needs to be pooled. And then repayment, you could do long-term, about 20 years. This one, short-term, 3 to 5 years. When they say that, they're saying the construction loan itself, because it's gonna go from a construction loan, you're gonna close on the house, and it's gonna become a permanent mortgage. You're gonna have a mortgage at that point, because that's the most common one, is the construction to a permanent mortgage that you're gonna end up using. Now, here's the rates and FICO score requirements. As it shows, construction loan rates typically range from 4 to 15% APR, while HELOC rates usually range from 4 to 18. You can get a loan with 620 FICO score, but 680 FICO score will significantly improve your chances of getting approved. Good credit score will make it easier to get a loan and qualify for the lower APR. That's on any loan, no matter what it is. The higher your credit score, the better interest rate you are going to get. Period. Plain and simple, super easy to end up doing. And then it goes into how much it costs to build a home. This is gonna vary. They're gonna show average cost, but in Northeast Ohio, yeah, normally, if you see, especially for the developers, if you end up seeing starting at X amount, that is the base house with the base, upgrade options in it. No upgrades, and that's also not including the lot. Now, when you got to do the lot, this is going to be for custom builds, or in this case, even if you do Drees on your lot, because they do build on your lot. Your land equity, you can use this for a down payment. So I just wanted to point this out for you, that if you own land or if you buy land, as soon as you purchase land, you have instant equity in that land. It just went up in its cost. It happens all the time. Now, the less you owe on it, the more equity that you have on it. So how does that land equity loan work? With this, you're cashing out some of your equity by putting up your land as collateral. If you default on the loan, you could lose the land to foreclosure. Never seen this happen, but again, there's always cases that are on that. Land loans are risky, but what they end up doing, the way they end up doing it is, because it's being built, the lenders are going to look into everything and make sure that you are good to go. Typically, it's all through the same lending company, and they will take it and do their thing. Now, with Drees Homes, what they will do is they will actually have you deed the land to them. So they basically purchase the land from you, and then they will build the house. And you don't have to get one of these normal construction loans that are permanent like you do with the majority of custom builders in the area. Drees will actually handle everything the way that they do in their developments with building on your lot. So that is a pretty big perk when it comes down to it. Obviously, they're semi-custom. They can let you do a couple things here and there, but they're not a full-on custom builder. But that is a good option that they give to you. The different types, land equity, line of credit, cash out refinance, and then the land equity construction loan. This is the one that we want to focus on because this is what we're talking about. If you're planning to build a house on the land, some lenders will accept your equity as part of a down payment on the construction loan. So if you do have that land, or you just purchased that land, you're gonna have some form of equity in that land. So if it is paid off, that's just more. And you could take that and they will use the land as the down payment. So you don't even have to pay anything out of pocket, especially if it's a builder that wants like 20% down. The land could end up covering you for that, which is awesome, awesome, awesome. And then it's just kind of giving you ins and outs of all the stuff, but I'm not gonna go over all of this with the land just because it's very broad of how they're talking about you using it. When in terms of just using it for construction loan, just know you could end up using that equity that you have in it for the down payment itself. And at the end of the day, the big thing right now, because inventory is low, demand is up, the big thing is ensuring that you're not moving multiple times, because there's really no place to rent either. A lot of rentals, they're super high, they're very limited. So the best thing to do is look into one of these avenues for purchasing a home, and with all the incentives that they have, all of the money off, it's just gonna benefit you more, and you could end up affording more of a house than you think, especially with the equity that you have in your house. But let me know in the comments down below how you feel about this. Like, is this enough to kind of get your wheels turning a little bit and just thinking to yourself like, you know, maybe we can end up building right now? Let me know in the comments down below. If you need any help with this whole process with building, again, this is one of my niches. I have 15 years experience in construction doing this, and I have people just like you that reach out to me every single week. Contact me directly here or go in the description below. Use one of the links I have listed there. And if you got any value from this video, be sure to smash the like button. It's greatly appreciated. If you haven't already, click subscribe, turn notifications on so you can stay up to date on future videos I have coming your way.